Nvidia is the king of the AI market, so much that some analysts believe this company will make over $200 billion in revenue this year alone, thanks to the growth of the AI market. So now, being the AI king, you get to partner up with a lot of companies. And luckily, if those companies do really good, it can open up a massive opportunity for individual investors. And that's what we're going to take a closer look at today's episode. Today, we're going to look at a company known as Navitas. With a market cap of less than $1.5 billion, they recently announced a collaboration with Nvidia, which has created massive excitement for the stock, driving over 128% returns year to date. Now, the company is expected to report earnings. And now the question is, are those expectations given by this partnership with Nvidia creating massive risk in the short term for investors? Let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so like I mentioned, we are going to focus on Navitas. They are reporting earnings this week. Actually, they are reporting Monday after the market closes. This is a super small company with a market cap of roughly $1.5 billion. We have a 52-week high of $9.48 and a 52-week low of $1.52, currently sitting at $7.96. Now, the main thing that we're seeing here is on May 25th of 2025, Navitas mentions that they're developing next generation 800-volt high voltage DC architecture with Nvidia. So what does that mean? So I'm going to explain it in a bit. I have a pretty cool presentation for you, but it's great to understand how the data center and these AI servers work right now. So you have kind of this power coming in from the towers outside, and that's about 13.8 kilovolts in AC. And then through various steps, it steps down from that to you have an AC to DC converter. So you convert it to 800 volts DC. So you're stepping down and changing this voltage. And then you do even more step downs until you have a server GPU. Now, there are a few things, kind of the step down process you do are inefficient. You produce a lot of heat and you lose a lot of energy in the data center market or kind of just in the data center energy. And right now, we do know that power constraint is a major issue. It's one of the biggest bottlenecks for AI data center growth. But what if there's a way to improve efficiencies with power solutions? And that's where this partnership came out of. All right, so now I have this pretty cool presentation to maybe help understand what are the changes and how Navitas is helping out Nvidia. So we saw the old way, there is this bottleneck. So today's data center use a 54-volt architecture, which is hitting its physical limits. And as power demands for AI servers soar past 200 kilowatts, this system struggles, right? We do know that the current Blackwell per server is over 120 kilowatts for certain server configurations. So first, there's a physical limit getting pretty close for AI servers. And like I mentioned, right now, it's limited to a few hundred kilowatts, insufficient for where the next generation of AI servers will go. The second thing is this is inefficient and bulky. This requires heavy, expensive copper bus bars leading to power loss. Like I mentioned, efficiency is crucial. And if you're losing more power, you're gonna have a bad time. And it's unsustainable. A 1 megawatt AI server would need over 200 kilograms of copper, which is not feasible for the gigawatt scales of AI factories we're trying to build over time. Now the new way, which is this 800 volt HVDC. So Nvidia's approach converts grid power directly to 800 volts, streamlining power delivery for massive AI workloads like the Nvidia Rubin Ultra platform. So this maximizes efficiency, eliminates multiple power conversion steps, boosting end-to-end efficiency. So now you will lose a lot less power, which means you can power even more AI racks into the future. Higher power density delivers gigawatts of power efficiently, enabling next-gen AI infrastructure. And it reduces copper. Higher voltages means lower current for the same power, reducing copper wire thickness by up to 45%. Now, this is kind of the importance of this architecture is like we saw 5% increase to end-to-end power efficiency, 70% reduction in maintenance costs, fewer power supply unit failures, and lower overall cooling costs. So this excitement is what has a lot of Navitas shareholders excited about, right? I mean, with a company market cap of about $1.5 billion before the news, it was less than $1 billion. Any win with Nvidia's future growth could mean massive revenue growth at the scale compared to where you're at right now. So I do see why there is the excitement, but I also want to show kind of why maybe investors would want to kind of step back a little bit and think things through. I did a video a few days ago that on July 29th, onsemi collaborates with Nvidia to accelerate transition to 800-volt DC power solutions for next-generation AI data centers. So there are some competitions. Obviously, in this transformation of voltage, there are a lot of components. Maybe there's not the right competition, but there's still kind of a competition on the overall wallet spending. And that's something that NVIDIA investors should consider. Now, I also want to kind of take a closer look at kind of the company's recent expectations and earnings and valuation. So we're going to look at these great charts from fiscal.ai. And I do have a promotional offer. Check that out down below, fiscal.ai/Jose for 15% off. Great offer. I use this platform on almost all my videos and on a daily basis, even if I wasn't a partner. First thing we can see, forward price to sales ratio is 22.27. This is a lot higher than its median of roughly 9.76. Now, it is important to remember forward price to sales valuations are based on analyst expectations. And maybe you can argue that the market is not pricing this NVIDIA growth the right way. Well, that's what maybe a lot of people are saying. We're going to kind of take a closer look at why that might not be the case so far. Then what we also have, I also want to kind of show total revenues of this company in the last trailing 12 months. 74 million. It actually has been decreasing nonstop since June 2024. And we actually expect a little bit of a decrease as well this quarter. The main reason is this is a company that focuses on power solution, and most power solutions are being used in the electric vehicle market, which is in a complete downfall. The data center market is one that's expected to eventually help this market grow back up, especially with the tailwinds of EVs as well. This company is not profitable, net income of a loss of 97.7 billion in the last 12 months, and inventories have kind of been stable about $16 million, meaning there's not much need for growth right now because the market is pretty weak. Now, obviously, revenues suck, but I want to say this company does have a decent balance sheet. Cash flow, negative free cash flow, unfortunately, of $56 billion, but they do have about $75 million in cash and cash equivalents. They also do have no long-term debt at all, and they don't kind of issue shares or unfortunately haven't repurchased shares either. So overall, the company, while it is burning cash, if the market starts to turn around, it's at least right now in a very clean balance sheet. What you want to see is maybe that cash flow or that cash not burn as much as it has been in the past few quarters, and kind of see free cash flow also improving over time. Now, I wanted to show kind of revenue consensus. So revenue consensus here for June of 2025, which they report on Monday after the market closes, is about $15 million. Not much growth from March of 2025, and it will be a decline year over year. Now, guidance for September 25 is expected to be somewhere around $16 million. So you see a small growth. So we see that right now, this NVIDIA partnership is not driving much growth expectations from analysts. We really start to see more growth coming in December of 2025. Now, this is the fun part of investing in stocks in an innovative market. A lot of these timelines could shift. It could actually shift in an earlier time frame, and maybe we get even a better guidance in September of 2025 than what the market expects, and that could create a bullish sentiment. It can also take a little bit longer. You can kind of get it pushed out, and that could create negative pressure for the stock. But I wanted to kind of show this number that even with this massive growth rate expected in December of 2025, it's still nowhere near some of the values it saw in 2024. I also want to take a closer look at earnings per share. They don't expect to be profitable until at least further into 2027 calendar year, but we do see some improvements over time. We actually see a small improvement. A loss of about -5 cents is what's expected this quarter, and a guidance of roughly -4.5 cents for next quarter. So again, still losing, but some improvements there. Now, I am going to share my thoughts in a bit, but I have some kind of key drivers that, while I've kind of maybe talked a little bit more about the bearish sentiment, I do believe there are some growth potentials. So this is Navitas semiconductor key revenue driver analysis. So in the near term, what is happening? So between 2025 and 2026, you do have AI data center momentum. Navitas has 40 customer projects ramping throughout 2025 and 2026 with strong engagement from hyperscalers like AWS, like Google and Microsoft. Right now, there's this low voltage gallium nitride for 48 voltage DC to DC converters, and it's being sampled now, set to ramp in the data center next year. That's probably why we saw for December a nice healthy amount of revenue growth. The data center market is becoming more crucial for Navitas. Now, solar market expansion. Enphase upcoming IQ9 microinverter will feature Navitas GaN technologies, marking GaN's mainstream debut in the solar industry. Ramp up expected at the tail end of 2025 and into 2026. Enphase can actually be a great indicator of what maybe we can expect with some of their solar markets. The mobile and EV growth. The company anticipates gallium nitride to achieve mainstream adoption in both solar and EV markets within the next 12 months. This continued growth provides a stable foundation for revenue. So in the near term, there are some excitements, but not that catalyst that we see from Nvidia. That catalyst that we see from Nvidia is actually expected more in 2027. So this 800-volt data center opportunity is for the Rubin Ultra, which is expected, like I mentioned, not 2025, not 2026, but the end of 2027. So you might start to see some revenue growth throughout the 2027 era. So Nvidia's announcement of 800-volt architecture for 2027 creates immediate development opportunities for solid-state transformer and power supplies. Nvidia reports significant inbound interest from potential customers following the news. And that's the great thing, right? It's not just Nvidia that will potentially be a customer. There's a lot of data center players out there and a lot of other companies developing ASIC chips that there is other opportunities from here. So the revenue from NVIDIA's collaboration, and Navitas is collaborating directly with NVIDIA on next-gen 48 voltage and 800-volt data center architectures. Now, the full 800-volt system is targeted for 2027, while that 48-volt is currently in production right now. We should expect more growth throughout the upcoming months. Now, the total addressable market outlook is still pretty healthy. The data center power semiconductor is projected to reach hundreds of millions to $1 billion. And Nvidia estimates 5 to 10 million per gigawatts for each of the up to five power conversion stations in a system. We're seeing multiple mega gigawatts data centers being built out all over the world. So there is a lot of growth potential for Navitas through this phase. Now, I also want to kind of talk a little bit about kind of their Q2 earnings preview. And if you are enjoying the episode, I haven't bugged you just yet, make sure to hit the thumbs up and the subscribe button. This is the best place you're going to find any semiconductor AI news out there. So, like I mentioned, Q2 earnings are happening Monday after the market closes. What are the narratives right now? First, cyclical weakness. Low-teen revenue outlook reflects softness in solar, e-mobility, and industrial markets, the core markets for Navitas right now. We do have a strategic pivot, focusing shift to higher margin GaN and silicon carbide for AI data centers and EV tractions, which are still in early ramp. Future growth is expected in the second half of 2025 as new design wins moves into full production. But the biggest catalyst from Nvidia is not expected to at least a year and a half from now. Now, in the last 4 weeks, we have seen a few analyst updates. We see Rosenblatt increase price target to $6 from $4. Unfortunately, we see Needham decrease price target from $4 to $3, but still giving it a buy rating. Right now, the market, though, this is a small company, so you don't really have many analysts covering this stock. So I really wouldn't care too much of analyst actions. Now, there are some catalysts and headwinds. First is there does a partnership with a Chinese player, Xiaomi. I'm pretty sure I butchered that name. My apologies. Where they confirm consumer charger leadership and volume starts Q4. but commentary on attach rate will be key. That's what we're going to be talking about during this earnings. They also talked about a 200 millimeter GaN fab deal with a chip manufacturing company, and moving to 200 millimeter wafers should cut wafer costs by 20% in 2026. Investors will want to learn more about that. Like I mentioned, that massive catalyst with Nvidia, which they announced in May, we would like to hear more about that during the earnings. But we don't expect much from there. If they give us something, that would be super, super amazing, in my opinion. Macro environments, the EV space, the industrial space, the products that are core for Navitas right now are definitely susceptible to macro environments, being tariffs, being trade tensions, and the list goes on and on. So yeah, there is a lot of excitement here. I'm not a Navitas shareholder, but I'll share my overall thoughts. What's definitely going to be crucial is Q3 bookings, gross margins trajectory, cash burn runway. How is that improving? Design wins on the AI market, any traction in that? Also design wins in the EV space, any design wins on the mobile space? And now that we see this kind of win with Xiaomi, again, I'm pretty sure I'm butchering that name, China exposure, what is going to happen with that market as well? So let me just finish off this episode with my thoughts, and hopefully you guys enjoyed it. So my thoughts. There is massive growth potential here. No doubt about it. We keep hearing that the power market is critical for the AI space, but very, very weak short-term market. We see kind of revenue expectations, not much growth expected this quarter or even next quarter. Is the market prepared for this low growth for the next few quarters? We keep hearing everybody hyping this stock up because of the Nvidia partnership. If you hear that, you think revenue growth is expected right away, but we'll only see year-over-year declines. Could this create a massive sell-off? Well, if the market is expecting this Nvidia growth right now, I think yes, it can. Now, if the company shares more information of data center market growth and accelerates timelines for revenue growth, then this could accelerate the stock momentum. I, at the moment, have no position on Navitas. If a sell-off happens after earnings, I wouldn't mind entering, but this is because this seems like a more high-risk, high-reward market. It has a collaboration, not a exclusive collaboration, but with the $1 billion market cap, if things go in the right direction, which they do seem to have a very strong leadership, this could definitely be a multi-bagger. But with competition, it could also be a massive loser. So if one is thinking about getting into Navitas, think about that. Think that the growth is not expected this quarter, not expected not next quarter, and this Nvidia partnership is not exclusive, but it does have opportunity for a year and a half from now, maybe even a little bit longer. So take care, have a good day, and see you all next time.